Hey guys, well, we are done with spring break, unfortunately, but that's okay. The sooner we get back at this, the sooner it'll be time for summer break. So, anyway, as I said in my announcement, that hopefully that you've seen, we've got 5 chapters left, and the first 3 have to do with budgeting, and then the last 2 are a little different from each other, but they just kind of wrap things up a little bit. So, what we're going to do is we're going to take 5 chapters in 5 weeks. We're going to cover about one a week, and fortunately, in this format, you can actually watch these videos and study the examples in the textbook and do the homework at your own pace. So don't wait till the last minute, of course. But what we're going to do is I'm going to try to load these videos 1 chapter a week. Each chapter will have, maybe 2, 3, 4 videos. I don't want to have the videos too long. I'd like to break it up into shorter videos so that you have a chance to absorb one portion of the chapter before we move to the next one. So anyway, let's get started. We are starting with chapter 20. Again, now this next exam will be the trifecta of chapters 20, 21, and 22, all dealing with budgeting. And chapter 20 starts off talking about the master budgets and performance planning. So I'm going to move forward here. Here's the text as we move through it. We're going to talk about what is budgeting and how does that process work, and exactly what are budgets. Now, many of you might have been involved in a budgeting, and we all know what a budget is. A budget is it's basically a financial plan. And even though we don't have perhaps personally formal budgets, we don't write down what my budget is, a lot of people do. My daughter is definitely, she likes to write things down, and she's a list person. She likes to make lists of things. And I think if I asked her, she probably has written somewhere what her monthly expenses are and what her monthly income is, and because she likes to see things visually. But most of us don't, but most of us at least have it in our mind. We've got it in our mind as to how much we make and how much I can spend, and if I see something at the store I want, we probably go through that virtual budget that I have in my head. Can I afford that? If I put it on payments, can I afford payments on that? And that's what budgeting is. Now, businesses actually go through a formal budgeting process. They don't just walk around with it in their heads. They want to get it down on paper, and they want to get a lot of input from a lot of different people, because a moderately sized company is actually made up of, they probably have a sales department, and they have a production department, and they have a purchasing department, and perhaps they have a delivery department, and as you might imagine, these departments all have to work together to make sure that they're all on the same page and they're all working toward the same goal. We don't want sales to get ahead of production. We don't want sales to get behind production. And we want delivery to be about even with the sales as well. So we want to coordinate these activities. And budgeting process is the best way to do that. So what is budgeting? Budgeting is, it's a process of future planning is really what it is. So, let's see, okay, strategic plan, okay. What's the process? Good multiple choice question here. What's the proper order? Well, people get together in a business, they develop this budget, work out the best budget they can, develop a budget, and then as the period that I've budgeted for, as the year goes by, we see how we're doing compared to that budget. We don't just prepare a budget and then put it in a filing cabinet. That's our plan. So we get this feedback, and based on how we're doing compared to the budget, we may need to take some kind of a corrective action. That, hey, we're not on budget, we need to kick it up, we need to kick it down, whatever it is. And then when the end of the year comes, I use what I've learned through this year, through last year's budget and the actions I've taken, to perhaps maybe set new plans this year. They will at least affect next year's budget to see how we're doing. But I may need to take the plan that we were developed in the first budget's not working out, so we may need to set new plans for the rest of this year. So, yeah, budgeting is a good thing. Most people that are involved in it find it to be a really kind of a pain in the butt, but it is a good thing. What are the benefits of budgeting? Well, it's always planning. And planning is never a bad thing. It reminds me of an old stupid cliche, but it's true. People don't plan to fail, they fail to plan. And without people looking ahead and trying to make to get a feel for what's ahead, how can you possibly be ready for it? So by the budgeting requires me to plan ahead. It develops, and when I do make this plan, it provides these benchmarks. It gives me a something that I can look at. So as the years going by, am I on target? Am I where I wanted to be when I established this budget? That way I can take corrective action. It's how do I know if I'm doing well if I don't know what I'm supposed to be doing? So that's same thing for employees. We set budgets for employees, and those that meet the budget get raises. Those that don't, get hammered. So anyway, coordination. This is probably one of the two, and these two kind of go together. It requires the various departments in a business to communicate with each other and to coordinate their efforts so that when sales needs to make a sale, production can fulfill that order. Or that we're not producing so many items that we can't sell them, because it costs money to carry inventory. You got to pay for space, and if that item is perishable, it may go bad before we have a chance to sell it. So it requires departments to communicate with each other and to coordinate their activities. This one I'm not so sure about. It says that a good budget will motivate employees. We'll set a goal for them, and that's great, I can do that, and it'll motivate them. I remember from a management class that I took when I was in college that budgets can also be demotivating. If they are set too high, if the budget is a little bit too much, employees may look at it and just say, ugh, I'll never be able to do that. Why even try? So you want to have a realistic budget, of course. It's got to be realistic. And if it is realistic and challenging, the theory is that it'll motivate employees to get there. Budgets involve human behavior, of course. And so how should the human behavior be built into this budget? Well, first of all, employees will more likely embrace a budget if they had some input into it, and that's called participative budgeting. Is allow employees and allow the managers of these departments to have input to it, and they may take an ownership of this budget and place a greater level of importance upon it. But just to have the owner of the company lay out a budget and then just hand it out, here's your budget, guys, you meet it or hit the road. Well, employees are probably not going to be very likely to accept that with a great smile on their face. But if they were consulted and they were allowed input and they provided what they thought was what they thought was important, then they will probably more likely, like I said, it'll become partly their budget as well. Budget should be actually established from a bottom-up process, not from a top-down, not from the owner at the top telling everybody below him what's going to happen, but to allow the employees to have the input and to build that budget with their input from a bottom-up point of view. It'll be more acceptable at that time. Goals, they should be challenging but not unattainable. They should be challenging, and it also provides the opportunities for evaluations of employees as well, and also that provides those benchmarks. A couple negative outcomes of budgeting is what's called budgetary slack. When you have people participate in the budget, they may build in a cushion. Yeah, the production guy may know he can produce 100, but he's going to say, oh, maybe I think I can only build in 80. I can only budget me at 80, and so then when he does make 100, then he's over budget, or he's doing well, or so they may build in this slack just to make sure they can get it. So that's why companies, when allowing this participative budgeting, they have to monitor it and make sure that this budgetary slack isn't built into it as well. So budgeting, getting people in the organization together, communicating, coordinating their efforts, and coming up with a challenging yet attainable budget. Budgets are usually for a 1-year period of time. They're a 1-year period. But some budgets, so many times, in 2019, we'll prepare the budget for 2020 and watch that budget and watch our actual compared to that budget over 2020. And at the end of 20, we'll prepare the budget for 21, and we'll watch that budget as we go through 21. There is something called continuous or rolling budgets, and that's something like this where as each quarter expires in a budget, we'll actually prepare the budget for another quarter. So at the beginning of 2016 here, we have our budget for 16. When we get to March of 17, when we get to this point, then we see, well, how did we do? How was our actual performance compared to this first quarter budget? And so now at this point, 3 months into this year, well, we have the budget for the second quarter, third quarter, and fourth quarter already established. Let's create the budget for the first quarter of next year. So now I still have a year in front of me. Well, then we go through the second quarter, and then we get our feedback, see how we did. We get to the end of the second quarter, and then we still have our third and fourth quarter, and our first quarter we developed. Let's add another quarter, the second quarter of next year. So we constantly have about a year's budget ahead of us. It kind of smooths out the budgeting process. We don't have to do it all at the end of the year for the entire next year. It kind of keeps us going, and I kind of like this idea because it requires us to address the budget every quarter. Plus, it allows me to build in what I've learned in one quarter in adding that next quarter on. So that's a good thing. I like that. Budgeting. Now, there is something called a master budget. The definition of a master budget is a comprehensive business plan that includes a bunch of mini budgets, a bunch of mini budgets. And here's what the master budget is. A master budget is made up of the sales budget, production budget, direct material budget, direct labor budget, and so on and so forth. These are all budgets that have to be developed, and collectively they're known as the master budget. Now, where does it all start? Well, it starts here with sales. Most companies will sell, let me start again. Most companies start with, can they sell whatever they can produce, or do they strive to produce whatever they can sell? And most companies realize that they are in competition with other companies, and they can only sell so much. So they want to know how much they can sell, and that's what they'll produce. Now, some companies like gold mines, there's a fixed market for it, so whatever they can produce, they sell. So they're in a little bit of a different boat, but for the most part, most companies they say, well, how much can you sell? And then that's what we want to gear our production toward, is how much we can actually sell. So everything's going to be driven by sales. So sales is the first budget that we want to prepare. So of course the sales manager or the people in marketing will be involved in this budget. Not everybody's involved in every budget. So I would probably get the president of the company and probably the vice president of marketing and maybe the accountants involved in the sales budget. So let's determine what we think our sales will be for the next coming period of time. So here's where in this chapter, we've got an ongoing a problem, and they're just saying that here it is, September 30th. Here's my balance sheet. Here's what I have in cash. Here's what I have in accounts receivable. I have my raw materials inventory, finished goods. There's no work in process. I have some equipment that I'm using, payables, income taxes, so on and so forth. So this is used throughout the chapter in their examples. But let's start with the budget. The sales budget. What is the sales budget? Well, here's what a sales budget looks like. There's not much to it. It just says, for the coming year, starting with, remember, this is our starting point, September 30th of 2017. So the budget for the next year will start on October 1st and go to September 30th of 18. What do I think my sales will be for the coming quarter, which is made up of 3 months? Here's my sales budget, and if this was a rolling budget, or who knows what it is, but it's just a budget. We're going to budget out for the next 3 months, or we could budget for 6 months, or we could budget for a year. But they're budgeting here for 1 quarter, for 3 months. For October, November, and December, they think that their sales in October will be 1,000, and for whatever reason, in November, they'll drop down a little bit, And then in December, they're going to come back up. Maybe this is a Christmas season type thing. Who knows? But this is the number of units that they think that they can sell in the next 3 months. And here's the selling price per unit. So the total sales budget, they're budgeting sales for October at $60,000, budgeting sales in November at $48,000, and December at $84,000. So for the quarter, they're going to have a budget of $192,000. Now the selling price per unit doesn't necessarily have to be the same every quarter. This could be a seasonal thing where it's going to start high and it gets a little bit lower as Christmas comes or something. But in this text, I think they're going to keep the sale price of the units the same. But looking at this is a pretty easy to understand budget. How many units do I think I'm going to sell each month? What's the selling price? And therefore, what's my budgeted sales? So given that, we can now determine what I need to produce as far as production goes, because the next budget that I produce based on sales, that drives production. Production doesn't drive sales. Sales will now drive production. So I'm going to sell 1,000 units in October, 800 in November, and 1,400 in December. How many units do I need to produce? Well, you may think, and I totally understand this, you may say, well, I'll just produce 1,000 in October, 800 in November, and 1,400 in December. But it's not quite that simple. The production budget takes into account beginning and ending inventories as well, because I don't want to start on October 1st. I don't want to start on the 1st with 0 units. I need to have some units in inventory. I'm going to sell 1,000 over the month of October. Some of those are going to be at the beginning of October, and it may take time to produce these. I mean, if there's a drying process or a curing process of some kind, I don't want to say, well, okay, I'll make 1,000 in November. They'll all be ready by October 31st. Well, that's not going to work, because I need to have some on hand to cover the sales in the first part of the month. So I need to carry inventory. So I need to have 1,000 units to sell in October, but I also need to know how many units I'm going to start with, because I don't need to make those this month. And I also want to end with some units so that when November begins, the sales in November start, I have them on hand. Well, those units that I'm going to sell at the beginning of November, when do I have to make those? In October. So I do need to temper the sales figure by beginning and ending inventory. It may look something like this. If I'm going to sell, I'll say during the month of January, I want to sell 2,000 units. In February, I want to sell 3,000 units, and in March, I want to sell 4,000 units. But again, I'm going to have inventories. There's going to be inventories on hand at the end of every month. And the question becomes, how much inventory do I want to have on hand? How much inventory do I need to have on hand at the beginning of January to help cover, to be able to sell? Now, I don't have to have 2,000 on hand, because I have this period of time to make some, but I do have to have some on hand here. So the company has to come up with a rule, some kind of an algorithm that just says how much inventory do they want to have on hand to start a month. And I'm just going to pick one out. I'm going to say we want 10% of a month's sales on hand at the beginning of the month. We'll make the rest this month, but I want 10% on hand at the beginning of the month. So in January, I'm going to sell 2,000 units. How many of them do I want to have on hand on January 1st? I want to have 200 on hand on January 1st. And then when I get to the end of January, I'm going to want to have inventory on hand at the end of January of how many? Well, 10% of the following month's sales. I want to have 300 on hand. At the beginning of February, to sell during February. And when I get to the end of February, how many do I want to have on hand? I want to have 400. It's always the same thing. It's a certain percentage of the net of that month's sales. And in my case, it's 10% of that much sales. So what do I want to have? How many do I need to produce then each and every month? It's a function of this. It's a function of start with the number of units I need to produce is a function of how many are you going to sell? I need the units to sell, plus how many units am I going to want in ending inventory? I need to make those, but I don't have to make the ones that are in beginning inventory. That's how many units I need to produce. So follow this example. In the month of January, I want to sell 2,000. I want to actually sell 2,000, and I want 300 on hand on January 31st. So I need those 300, but I'm going to start this month with 200. So how many do I need to produce? I need to produce 2,100. Even though I'm going to sell 2,000, I want to produce 2,100 because I want to increase my inventory level by 100 units. How about February? Well, I want to sell 3,000, and I want ending inventory of 400, but I'm going to start with 300. How many do I need to produce? 3,100. How about March? Well, I'm going to sell 4,000. I want to have, I'm going to have to peek into the future here. How many do I plan to sell in March? April. Maybe I'm going to have 6,000 in April. Well, I want 600 on hand then. 600, need the 4,000 to sell, the 600 on hand, but I'm going to start with 400. I need to produce 4,200. So it's not, the production budget is simply a budget that tells me how many I need to plan to produce. And it's not equal to what I'm going to sell. It's what I'm going to sell plus what I want to end up with, which is a function of percentage of the following month's sales, minus what I'm going to start with. They'll already be here. I don't need to make those. So the production budget looks like this. I don't really like the way they presented this production budget because they start by calculating the ending inventory that you want, then they add the sales, then they subtract off the beginning inventory. It seems more common sense to me to start with the sales, add the ending inventory, and then subtract the beginning inventory. But it's all the same basically. So this is where they're starting with the number of units that we want to sell this month, and then we add. I'm sorry. Oh, I see what I'm doing. Hold on. Going back to the sales budget, we're going to sell 800, 1,000, 800, and 1,400. So if I want to know at the end of October, what do I want to have on hand at the end of October? What's the ending inventory? I have to look at November sales and take a percentage. And that's what they did here. They said in October, what do I want to have on hand ending inventory in October? And the ending inventory is, in their case, they want to have, 90%. They want to have 90% of the number of units that they're going to sell next month. They want it on hand at the beginning of the month. So if in November we're going to sell 800, how many units do I want to have on hand at the end of October? I want 90% of those. That's how many units I want to have on hand at the end of October. 90% of November sales. So I need those 720, plus I need the 1,000 I'm going to sell in October. That's 1,720, but I'm going to start with 1,010 units in inventory. And where's that 1,010 come from? This was our beginning point right there. I'm going to have 1,010 units. That's what I have at the end of September 30th. So I need to produce 710 units. November. What do I want to have on hand at the end of November? I want 90% of December sales, which is 1,260. Plus I want the 800 I'm going to sell in November for a grand total of 2,060, minus what I'm going to have on hand to start with. So you can see where the sales, the production is a little bit different than sales just because of ending inventories. Now, notice that the production budget doesn't have any dollar amounts. It's a production budget is strictly a number of units to be produced. We're not dealing with how much it's going to cost to produce those. This is just to tell the production department how many units they need to plan on producing. Where do the numbers come from? Well, it's right here. The production budget tells me how many units to produce, so how much will that cost? Well, as we go way back to the very first chapter of the semester, what does it cost to produce something? It costs direct materials, direct labor, and I'm going to have to incur factory overhead. And those all represent their own budget. And they are driven. The amount of materials that it's going to cost, the amount of labor it's going to cost, and the amount of overhead that it's going to cost is a function of the production budget. So once I know how many units I'm going to produce, then we actually prepare the direct materials, direct labor, and factory overhead budgets. I think that's where I'm going to stop this video at for now, just because we're at about 26 minutes right now, so that's enough for us to at least absorb basically what a budget is. So please review this first part of the chapter, what a budget is, what are the advantages of a budget, what are some of the things that we want to look for, like budgetary slack, some of the things we want to try to avoid. And then the master budget. Let's start becoming familiar with what the master budget is made up of. It starts with sales. Sales drives production. And production is basically sales adjusted for ending inventory and beginning inventory. What I'm going to sell plus what I want to have on hand at the end of each month, which is a function of the following month's sales, minus what I'm going to have here already to start the month with, is how many I need to produce. Next video, loaded tomorrow or the next day, will deal with direct materials, direct labor, factory overhead, and I believe selling and administrative expenses. So look for that in a day or two. Keep working at this at a pace. Don't wait till the last minute to try to put this all together. Give yourself a chance to learn it, and it'll all work out. We're all going to get through this together. Okay, stay safe, 6 feet away from everybody, and we'll see you next time.